Okay, all right. All right. My name is Marco, and today I'm going to talk about Fuji. Let me put my perspective, right? I live in Bitcoin, with Bitcoin. I get my paycheck in Bitcoin. I spend Bitcoin every day to live. And as much as I want to live in a Bitcoin standard economy, we are not there yet, even here in El Salvador, right? And I really think that a proxy like a stablecoin will definitely be needed for the short term to move to a Bitcoin standard. There are various types of stablecoin, right? And let's start with the algorithmic one. And that is definitely, let's say, a stupid idea. It was a stupid idea, and still it is, right? How you can print, your own coin, your own token, and think about that you can back it, right? That you can follow, that you can track something volatile. And we saw Luna and Terra, collapsing. We saw that it failed the masses. And on a side, we were right, so we got a win, right, as a Bitcoin maxi, so to speak. But at the same time, it drove back the ecosystem in general. Fiat-backed stablecoin they resisted the crypto contagion, right? If you go to Istanbul, you can literally go to Bazaar and exchange Tether for actual cash, or if you go to Dubai, you can buy cars and villas with Tether. So it's actually happening. But being fiat-backed, being the fact that you have a bank account, and this is there could be regulatory capture, and maybe in US we already know that fiat-backed stablecoin will be deemed as securities. So they will work. They will still going to work, but they will limit the amount of jurisdiction that they can operate. There is a third option, which is they are kind of called crypto-backed stablecoin, but unfortunately there is no Bitcoin native solution to that yet. Here's where Fuji come in, right? Fuji is a protocol that combines Lightning and Liquid covenants to create an over-collateralized Bitcoin-backed stablecoin. Anyone can borrow interacting directly with a covenant and can take back the collateral without having any intermediary or any third party like an escrow. How it works. Let's say Alice wants to issue 100 Fuji USD in this case, right? What she's going to do is lock in, let's say, $200 worth of Bitcoin directly in a covenant. This will grant her the permission to issue 100 Fuji USD. Then she can go around, can spend it, can use it, she can do trading if she wish. And at some point, if she wants to take back her collateral, she just go to the covenant, to the smart contract on Liquid, and take it back. This process is non-interactive, meaning that there is no interactivity with any party, any intermediary, or any escrow. I think I want to remark again the fact that it's non-custodial, in the sense that you controlling your own covenant and with your own public key, as long as you burn the synthetic asset, in this case the Fuji USD that you issued, you can always take back your collateral. Of course, if you fail to keep enough collateral above the liquidation price that the parties agreed beforehand, eventually there will be a liquidation. Another point very interesting, especially compared to Ethereum, for example, Ethereum ecosystem. In Bitcoin, but especially in Liquid, what you can do is you can use blinded oracles. A blinded oracle is not pushing data, is not aware of the contract on chain, like for example in Ethereum, right? So oracle need to be aware of the contract and need to push prices. Instead, with DLC, for example, in Bitcoin, also on Liquid, actually maybe an exchange or a public price feed, just making an attestation, a public signature about that price, and everybody can take it, and eventually liquidator will take it and use it. And the exchange and the price feed doesn't even know about that contract existing, if there is one contract existing, or maybe 1 million of contract existing there. Another important topic will be that ideally you can use Lightning to fund directly your covenant and to take back your collateral. And this is thanks to the ability to do summary swap between Liquid and Lightning, the same way you will do it, for example, on chain, between Bitcoin on chain and Lightning. There are a couple of projects allowing you to do this, like PeerSwap or Bolts Exchange also is adding liquid support. Our idea will be also to try to serve the trader use case, and the idea will be to still using covenants to create a non-custodial derivative exchange using an automated lending pool, which will allow anybody, to lend or borrow Fuji USD to be used as a collateral to, go long or short on any pair. And the idea will be that basically lender, they can take back, their funds at any time. They don't need to go peer-to-peer to the borrower, to the initial borrower, and to negotiate a clawback of the funds. We are going also to work on a more retail-oriented mobile application, which will be a Lightning wallet that will allow you to borrow on the go with Fuji USD that will be used to buy Visa prepaid card. Why this is important? In a lot of jurisdictions, you are going to pay capital gain taxes when you want to spend your Bitcoin. So if, like me, you live out of Bitcoin, you got your paycheck in Bitcoin, in some jurisdiction will be very, very hard to use it in normal day life. But if you can borrow on the go against your collateral and then having this kind of line of credit that can allow you to denominate a Visa prepaid card, then you can literally live out of it. Without having KYC, especially. This is possible in US, but we were looking also for international Visa prepaid card. So maybe someone can say, okay, why Liquid Network? Why not another chain? I mean, maybe in a Bitcoin conference it will be obvious why not another blockchain, but I think just to remark why I think Liquid is very interesting sidechain to make financial application. The first will be the fact that there is no miner extracted value, meaning that the block producer cannot see, thanks to confidential transaction, what's happening there. So miner block producer cannot front run you, and even your competitor cannot see what you're doing. If you're a trader, they cannot see in plain sight that you are borrowing, for example, from the protocol. I do think that is a much better Bitcoin bridge compared to other wrap Bitcoin in other chain, to the fact that it's very interoperable with the Lightning, in general, with the Lightning infrastructure and the Bitcoin ecosystem. You can peg in, and then you can do some money swap to go in and out of Liquid at Lightning fast. There is also quite few scalable DEX working on Liquid. One may be TDEX, but also Bitmetrics, which is Uniswap built using covenants. And the idea will be trader can trade against a covenant and everybody can be an LP, meaning a liquidity provider. And that will be very important for Fuji and Fuji USD for price discovery. Who are the users of Fuji? I think, as I mentioned, most likely if you live in a jurisdiction that will tax your if you spend Bitcoin will tax you with capital gain taxes. That would be definitely useful. The other alternative at the moment are custodial lenders, right? And in general, they charge you a recurrent interest rate. Or the other more trader-oriented use case will be going long on your collateral. And most of the people, they like to be to keep their Bitcoin in cold storage. But we know that a lot of Bitcoiners like us in the last, especially in last bull run, they use a lot of centralized crypto lender to go long because we do believe in Bitcoin long term. And this approach will essentially be a way to keep maybe potentially always open contract position using your Bitcoin collateral. Who are the oracles? Technically, everybody can be an oracle, right? But in the end, will be the user picking which oracle or maybe even multiple oracle to be put inside the covenant, indeed. And I think that at the moment we are working with, Bitcoin-friendly price feed provider like Bitfinex, and also Blockstream Data with their public price feed product. They will basically keep doing what they're already doing. They already have a public price API. They are just adding a field, which is a signature attestation to that specific price. This way, the covenant can use it to determine if the liquidation is due. What's the business model? I think the business model of Fuji is pretty straightforward. You have a contract fee when you set up the contract, and then there is collateral confiscation in case of liquidation. It's worth remember that liquidation can potentially never happen in the life cycle of your contract, because if you top up your contract or you redeem it, right? You close it beforehand, before the liquidation can happen. Liquidation can theoretically never happen. There might be also a B2B offering, especially institution may not be comfortable with the fact that there is a potential confiscation of the full collateral, and I think that for them there will be the possibility to have a subscription model, so they can pay a recurrent interest instead, so they can have a 0% penalty on the liquidation and maybe have multiple liquid asset as a collateral and more offering like this. The current roadmap, we started last year in Vulpen Ventures incubating the idea, and we wrote a research paper, me, Dimitri Petukov, and Andrew Camilleri from BTC Pay Server. And this year we published the research paper, we got a lot of feedbacks, and then we decided to create a product on top of it. We are currently in closed beta. Right, so there are people trying. At the moment, we just onboarded 100 people from our waitlist, and they are helping us to making the product better, giving feedback on what they would want to use eventually in the future. And currently we are working with Oracle partner to make sure that will be reputable Oracle price feed. And the idea will be next year, Q1, to eventually launch on mainnet FujiUSD as a first synthetic asset of the platform. And as I said before, we're looking forward next year to try to create use cases on top of the protocol, such as a more retail-oriented mobile application, and also non-custodial derivative exchange on top of it. We currently have a very, very galvanized community, and there are people very, very interested in what we're doing. And in general, there is not only a kind of Bitcoiner that only wants to keep Bitcoin in cold storage, but eventually people like me that we live out of Bitcoin, we must spend Bitcoin, and we need to find the best way, eventually tax optimization, and as well also eventually if we want to go long on our collateral. So there are a lot of people very interested, and I will say if you guys want to try it, and I really invite you to subscribe and get in the waitlist, and I will definitely want to have you on board, test the app, which is currently in closed beta in testnet, and any feedback and any suggestion will be more than helpful to make the product better for the upcoming mainnet launch. And I think that's it. I think that this sparked enough curiosity, and if you have any question, please reach out, and I will be here for the day. So thanks. If there is any question, yep.
Thank you, that's great. What's the liquidation ratio? And since this is a kind of non-custodial smart contract, what are the features or that make sure that there is no automatic liquidation if say the Bitcoin price kind of collapses 50% in a few days? I don't know if you've thought about that.
Yeah, I just repeat the question just to make sure. So you asked what is the percentage of what's the liquidation, the target price, and also what will happen in a cascade liquidation. I think the first answer will be, at the moment we are starting in a conservative way, so we require 150% of the collateral, so above the actual reference price of BTC USD, which eventually, if our liquidation infrastructure will get better, or we can test bed in the future, we can lower it. But ideally, maybe for a borrower, it will be best for you to, I don't know, keep 200% on top of it, just to be sure to account for some huge swing. You can always top up, right? So just to answer your next question, you can always top up or you can redeem. There is no cooperation to be done. So it's non-interactive process, 100%. So eventually you can add collateral or you just close the contract before it's happening. I think there is some similarity to something that happened in the past on Ethereum blockchain. I think that the advantage of Liquid is the fact that it's a UTXO model. You can literally aggregate multiple liquidation transactions in a single block, things that in an account model like in Ethereum you cannot do. So definitely it's much more scalable and it will account for crash liquidation, and of course all contracts that fail to stay above the liquidation price, they will eventually get liquidated. No more question? Okay, thank you.